Fabio, this morning I was trying to think of a good metaphor for a financial stability hawk, and this is the best I came up with. So it's 11 p.m., and you're at a resort hotel on a balcony overlooking a wedding party below, and the guests are getting out of control drunk. And in fact, there's a large screen TV set up also, and a soccer game is on, and people are betting on the outcomes with large chunks of cash. The music is good, and in some ways, you think the party is really cool. But you ignore your worst instincts and don't go down to the party. The next morning, you're up for a nice run at 8 a.m. You feel great. You're back at the hotel at 9, and it's completely quiet. You ask the bellhop, "What's going on?" And she says, "None of the guests seem to be getting up and getting ready for checkout. And in fact, several have called for a doctor. They need capital infusion." A guy walks up to you and asks for $100 to meet his hotel bill because he lost all his money on the soccer game. And your response is, "What am I, the Federal Reserve?" So, with that, I'm going to say today's guest is Nellie Liang, a senior fellow at the Hutchins Center at the Brookings Institution, another think tank. Nellie has served at the US Treasury, the IMF, the CBO's panel of advisors, and importantly, she was the first director of the Division of Financial Stability at the Fed. It was a brand new division created after the financial crisis. I would also like to note she was nominated by President Donald Trump to serve on the Fed board during his first term. So before I turn it over to Fabio, I want to remind everybody that the Anderson Institute is independent. We aren't funded by political parties, their influence groups, or any special interests at all. So with that, I'm going to turn it over to Fabio.
Thank you, Craig. Thanks for the picture that now I have in front of me of that balcony. Whereas probably I was sitting there with Nellie when I was at the Fed, looking down. I'm going to step back for a second and ask maybe a bigger picture question, Nellie. So the connection between political cycles, policy cycles, and financial leverage. We have seen a bunch of changes at the Federal Reserve in terms of leadership on the supervision and regulatory side, from Vice Chair Tarullo, Quarles, Barr, Bowman now. And I was curious about what's your views on how those changes affect the cycles of supervision and regulation, and ultimately what's the impact on the financial cycle that tends to have much longer trend, if you want.
Okay, well, thanks. Let me just start by saying thank you, Fabio, Craig. It's nice to see you both again. And before I answer your question, I have to respond to Craig's financial stability hawk. As I heard it, my thought was the Fed would have taken away the alcohol, the punch bowl, the night before so that they could have avoided that question in the morning. So that would have been our philosophy, and literally take away the punch bowl. That was something. Okay.
Great move.
Let's see. So going to Fabio's question, which very timely, of course. So I guess I would start by just saying it's not unusual to have changes in the approaches to supervision and regulation with changes in political parties in power, right? That's usually expected. I would say, and I agree with you absolutely, that the kinds of changes we're seeing have become much more dramatic in recent years. The swings in the spectrum have gotten quite large, and maybe that's certainly since the global financial crisis, and could be partly causal as to why the political parties are so far apart. But that is true. I tend to think it has a little bit to do with having appointed a vice chair for supervision at the Federal Reserve. Most, not just the U.S., but many countries have set up federal agencies, banking agencies, regulatory agencies based on technical expertise that usually the Congress or whoever the legislators are don't have the kind of expertise to write the rules and regulations and supervise that's needed in these complex financial institutions. So they sort of delegate to the agencies that authority and rely on them to provide the expertise. And so they've generally been independent. And until the global financial crisis, most agencies or financial stability authorities didn't even involve the Treasury Department, for example. So in the US, we created the FSOC after the financial crisis with Dodd-Frank, created a vice chair for supervision. That injected more politics, almost by definition, into the supervisory regulatory space. I mean, some of it's warranted, of course. I mean, it's not, given the financial agencies might have to rescue a firm that requires taxpayer funds, it's not crazy to have the Treasury involved or in some of these discussions because the consequences may involve them. And macro-approved policies, with credit provision and that, that sometimes have implication for credit provision, that's also can be a political decision. But I think in the U.S., it's just the swings have gotten more extreme. And the vice chair for supervision, I think, has been part of that process that has made it more extreme. And not for the better. I don't think it's for the better, I guess, is where the crux of your question was going.
I guess what I hear you saying is there's room for fine-tuning financial regulation. That's fine. But it seems like what we see are big swings, like Fabio said. So are these swings caused by different philosophy? A loss of a central standard of what macroprudential supervision should look like? Are they caused by politics? I'm not really sure myself.
I think there's a general grounding of what is safety and soundness.
Okay.
And more degrees for macroprudential policy and whether you want to smooth a credit cycle or not. But I think safety and soundness, that's pretty standard accepted. I think the difference in the politics is the reliance on supervision with discretion,
Right.
versus rules-based.
Right.
So Nelly, you mentioned the GFC. After the GFC, when I was still at the Fed, there was a lot of work done to try to rewrite some of the rules and lesson learned in terms of vulnerabilities. Not just supervision, regulation, also the financial stability, creation of the Office of Financial Stability in terms of thinking of a new framework that was needed. That was in reaction of what we have learned from the financial crisis. Now, things change over time. The macroeconomic backdrop changed, right? We have low zero interest rate for a long time, technological change. So I think it's okay to reassess and adjust based on how things evolve. But I was curious, how do you see the current push toward the regulation? How much unleft business was, for example, after the GFC that has not been addressed, and how to place the current regulatory push in that backdrop?
So absolutely agree with you that there's always room and need to reassess regulations that you've put in, especially after the global financial crisis where there were some significant rules and changes and approaches. So it's not just about reassessing those specific rules and the effects on the institutions. It's also the effects on the broader markets and the implications it has. Banks are still central nodes of the whole financial system. There's no getting away from that. And so the rules you place on banks will affect the broader system. I think in 2020, following the COVID crisis, the March 2020 crisis, we were in favor of already revisiting the SLR. And the Fed in 2 years before that had been thinking about that. I think the new liquidity rules have always been, these are new rules. At some point, we should reassess whether they're working, whether they're not working, what could be improved. I think those are areas absolutely to look at. And capital, of course, is always critically important. Just the SIFI surcharge, the amount, is it about right? Is it not? I think all of those should always be, be in the purview of review. So it's been 15 years. It would not be surprising to find places that could be improved on the margin.
One thing Rajan raised, Nellie, was that we seem to be deregulating in a sort of pro-cyclically. The economy's growing. We have markets at very tight spreads. But yet, we're talking about fiddling with liquidity and capital. What do you think of that?
Yeah, this is not the most opportune time to be relaxing regulations from a macro-prudential policy perspective. On the other hand, although asset valuations have been rising, are pretty rich by most standards, equity prices, bond spreads, risk spreads, etc. Household and non-financial business balance sheets look pretty good. The banking sector overall is strongly capitalized. So some of the most significant vulnerabilities aren't especially elevated, but I would be concerned about relaxing too much given where we are in the cycle. So political cycles and financial cycles aren't totally in sync all the time. And so it's a little bit unfortunate if the deregulatory stance is very aggressive at a time when the financial cycle has the opportunity to get, very, very stretched.
Now, in terms of like post GFC, one last question. I think one corner of the system where some had argued that there was some left business was what used to be called the shadow banking. Now it's the non-bank financial institutions. One, because some of the vulnerabilities, I don't think they were actually addressed entirely post GFC. Two, because some of the activities actually moved there. Like everyone is talking about private credit, but just an example. I think three, also because as we have seen during COVID, for example, the Fed is pushing deeper into financial markets when they step in for lender of last resort purposes, almost being like a market maker of last resort. So I wonder, what's your view on where the proper supervisory and regulatory perimeter should be in this case for NBFI? Do we need a new framework? Do we have the right framework? Do we have the right perimeter here? What's your view on that?
No, that's a tough question. That's a question that every think tank who's in this space should be thinking hard about. It's I think there's, as you've written a lot about private credit, Fabio, and have spent quite a bit of time, and I think we all agree there's just not enough visibility or transparency in this market, and it is a business model that could be supportive of financial stability, right? It's got a funding model that's more stable than say a bank model or some short-term funding model. But without the visibility and transparency, there's always a risk. So I don't know if we know what the right separation of lending should be between private credit and banks. And they're not separate, as you know. Like the private credit relies on bank lines, and most everything relies on bank lines. So those are issues I think that still incredibly important to think through. But transparency is the key. And so when I was at Treasury, we were pushing quite hard to improve data transparency on a whole number of places. One is the bilateral repo market, which, is a little bit separate, but also private credit. I think a lot of the different agencies, the separate agencies, were trying each on their own to collect information. And we were trying to use Treasury and the OFR framework, the data collection utility framework, to sort of consolidate information so that they could all work collectively in a more efficient manner. I think those efforts still absolutely need to keep going. And the other area where I think this is incredibly important is it's not just capital, but like things like Volcker Rule, structural changes, right? Structural reform that have limited dealers' presence in, say, Treasury markets. And do we have the right balance between what dealers can do in terms of market intermediation in Treasury markets and what is being allocated, say, to hedge funds through, sort of renting their balance sheet to them. So those are two areas I think are just very important to better understand and to continue to do work on. But what the right separation, where the line is between what should be done within a risky but regulated institution versus a less regulated part of the market, which generally has less leverage, or has more stable funding. Those are big questions.
To me, the biggest vulnerability is the interconnectedness. To me, the biggest vulnerability, because against a framework where, in some sense, we have very little visibility, as you said, we don't have data. There's a cross-border aspect to that, and then this narrative that this is outside of the banking sector. I don't think it's fully true. Banks continue to provide financing in different ways.
Yeah.
It's also embedded into their business model now. This idea they partner up with private credit fund, for example, those fees becomes part of, they look at their business. So there's an incentive to keep the flow going because you get the business going.
And to the extent banks have to assess the risks of extending lines and participating in these arrangements with private credit firms, if they are bearing the cost of that risk and something happens to the private credit firm, but the bank is protected, that reduces the costs of the interconnectedness. Absolutely connected, but it's who's bearing the costs and will they have to internalize those costs?
I mean, at the same time, I agree with you that there are financial stability benefits, right? So the diversity of funding sources for the economy, the liquidity risk, barring the entry of retail, it's very different than a bank. So in some senses, you need to find that equilibrium between the balance.
That's right.
Between the right visibility and where the perimeter should be, but also incentivizing innovation. I think the point of where the right balance between regulation and innovation is, particularly at this time of very fast technological change. I think that's a super interesting question. I don't know what your views on that, where the balance should be.
Yeah. And the other piece is valuation metrics in private credit. Maybe that fits into transparency. It's slightly different. I mean, even if you knew all the connections, how the assets are valued, I think is like a critical issue.
It's pretty subjective, right? The marks are, it's not a real market as far as I can tell.
Well, there's not secondary market transactions, that are robust to provide. One could have said that about corporate bond markets for a long time. Not even private credit, but just like public corporate bonds. As you know, we've talked about some bonds that trade, once a week or a lot of them. And we've always had these issues about, I'm going a little aside here, but we've always had issues about public corporate bonds and being held in bond mutual funds that offer daily redemptions when the bonds themselves don't trade for days. But I think those issues are less severe than for private, which are just much more smaller firms, more idiosyncratic, that kind of thing.
Getting back to Fabio's question on the perimeter, two issues. So now we have stable coins, and they provide, like you said, they could be providing some financial stability in that they're a big pool of treasury bills at a time when our issuance is going up. So that's good. Um, but anybody I talk to out on the street, so to speak, who's going to backstop a stable coin if there's a run? It looks a lot like a money market fund. The answer is the Federal Reserve. So, what should the Federal Reserve do about this? It seems like it's already a problem of an implicit safety net. And then a second issue, which our Jim Klaus is thinking about. What happens, Nellie, if the Fed's balance sheet rises because of periodic instability in the Treasury market and it has to intervene? And this instability is the result of just no fiscal constraint at all. It's not that it's like an exogenous shock. It's an endogenous shock that we can't control our spending. And there's sort of backdoor fiscalization of the central bank with the balance sheet rising. So 2 questions there.
Wow. Okay. These are great questions. I'm saying great to also mean tough questions. So let me say, okay, stable coins. The Fed should make very clear that it is not a backstop for stable coin issuers. I mean,
Thank you.
I think they are. That said, I've been supportive of a regulatory framework for stable coins. In the previous administration, we put out a report in November 2021 when stable coins were still about 25 billion. They're now 10 times that size, to say they were a potential financial stability risk and we should regulate them for runs, to reduce runs, and the possibility of like this alternative monetary system being created, right? Like this was not something we thought was supportive of financial stability. The Genius Act has a lot of the elements that we would have supported, including, reserves and operational risks and limited activities of a stablecoin issuer. So it has a number of the features that we would say are critical. I would say are critical. That said, there are some problems with the Genius Act, which raise these issues that people are talking about. Who's going to backstop? So reserves, if you really want to be a payment instrument, you have to kind of ensure a one-to-one conversion. And so what Genius did was say, here's a list of reserve assets that are permissible. And there should be capital and liquidity regulation. And the issuer is limited to only issuing and redeeming stable coins. It's kind of like a narrow bank. It can't make loans. It can only do this payment function. But, okay, having said that, while it allows cash and treasury bills and even central bank reserves, if it's a sub of a bank, the issuer is a sub of a bankruptcy remote sub of a bank. It allows deposits of insured institutions, which is not insured deposits. It's deposits of insured institutions. And that's something that was a point of confusion. And it allows both repo and reverse repo, which somehow means this issuer is going to be able to borrow based on treasury collateral. So those to me cause the potential for bank runs, for a run on a stablecoin issuer. That said, there are capital and liquidity requirements, which is unlike a money market fund. But the legislation has some language that says it can only be regulated sufficient to ensure the ongoing operations. So how the regulators are going to write these rules to implement the statute is going to be critical.
The repo aspect, that raises credit risk for you?
Yeah, it raises, I think in bankruptcy, it gives a creditor priority over the stakeholder, the issuer. you want a payment instrument, the holder of the stable coin should be able to get its payment instrument in bankruptcy, should have priority over other creditors. Repo is always senior. So that has been a concern for me. So there are a number of protections put in, segregated assets, so it can be gone through bankruptcy. That said, the run risk is still there, is too high in my view for a large payment system. So that is a concern. But I don't see why it's necessarily the Fed. People would think the Fed would be the backstop. It is designed with a ability to go through bankruptcy.
Can I interject for a second?
Please.
I think the expectation, at least on my conversation I have with people, the expectation is because you have such type of collateral behind, that there are clear discount window collateral, for example, that in some form of system-wide stress, those would be easy to pledge to the Federal Reserve, and the Fed would take them. And especially if stablecoin issuer establish some form of banking entity, there would be a quick entry point into the balance sheet of the Fed. I think that's the concern that some people at least have.
So stablecoin issuers can be a non-bank, and it's federal, it would be an OCC charter of some kind. They could be, you could have the largest banks collectively create a new stablecoin and issue that. And it's supposed to be in subsidiaries of banks, not in the bank itself. On the other hand, they could also, I think what's going to happen with stablecoins is going to depend a lot on what the banks decide to do. They could tokenize deposits, in which case the use case for stablecoins could diminish. They could introduce their own stablecoin, and maybe they have some, they have a name, and they could take, based on that, get greater acceptance. So I think the future of stablecoins is very unclear still. My thought on my view on stablecoin legislation had been, we don't really know how this new technology will work, if it gets incredibly efficient, how it's going to play out. But it's here and it's growing, and we should put in some rules now to, protect consumers, investors, protect financial stability concerns. But it's not it's not putting a stamp of approval and saying the new payment system 5 or 10 years from now needs to include stablecoins. It may or may not, but they're here and growing and posing risks, and so we need a regulatory framework. But I think what's going to happen will depend a lot on what some of the banks choose to do here.
I think two more concerns that you heard in markets. One is there are some names already out there that are discussing structure where you could swap the stablecoins into essentially interest yielding accounts. So effectively, the stablecoin does not provide interest, but as you can do with banking account, you get swept directly into something that does give you yield. So it's an easy way to go around that. The second one, that's more from a European standpoint. One of the concerns I heard from friends there is if you have issuer that can issue both in the US and Europe, and that coin is interchangeable, and the rules on the collateral are very different, more lax in the US and much stricter in Europe. Their concern of some of these European counterparts is that if there is a run, you would immediately everyone would run for the European collateral because the rules are stricter, and that's higher likelihood potentially you get the collateral back there. And so that regulatory arbitrage would work at their disadvantage in some sense in that international player. I don't know if there's an answer to that, obviously, but that's what some in Europe are focused on.
I think the Genius Act has some extraterritorial provisions, and I would imagine other countries will want to put in their own extraterritorial provisions. But the idea is that stablecoin issuers domiciled in another jurisdiction should not be able to issue to U.S. residents unless they have comparable regulatory standards. And so how that all works out, at FSB, there was a lot of work on what are common standards, so one could think of some interoperability if they got to that point. But right now, it's US dollar denominated is the dominant currency. I would think one of the bigger concerns could be smaller countries worried about the viability of their own currency, where US dollar-based stablecoins are growing, because stablecoins are often like a substitute for, the technology of stablecoins is a substitute for less stable currency at home, less strong financial regulations at home, and sort of it's a way to get dollars and a more stable value payment instrument. So I think that's a big concern, is less sort of monetary control at home for some countries. But those are big issues for global regulators to work through.
As we're talking, it seems like even now the regulatory cycle's behind the innovation. I was reading over the weekend that I think Coinbase or one of these fintechs has basically mimicked the credit card transaction system with a stable coin. So there's an escrow account. There's a brief hold where the buyer can refuse. There's a refund mechanism. So they've overcome this issue of when you hit buy, it's gone forever. And they've created a mechanism now that's basically mimics a credit card. So again, it seems like this is not going to slow down.
I think there's the technology. I mean, I don't think the credit card networks are like afraid of stablecoins. They are trying to figure out how to use stablecoins themselves. And, it could be the services they provide, like the protection and stuff, is on top of the payment technology, the distributed ledger, whatever they're, to do that. And they're incorporating it and not necessarily a competitor. I mean, at some, again, 5-10 years from now, this just could be the underlying technology of many payments systems, and credit cards being one.
Nellie, how do you see you mentioned FSB, the future of internet? You and I were both involved with the FSB in different times and different shapes. I always thought it was a great forum for discussion, but also to set the stage to think about issues that only at the cross-border level you can only work in that place, not at the national level. How do you see the future of that when you have technology that they're fast-growing and global? You have different pushes in terms of regulatory posture, like the regulator in the US, Europe still at least seems to be in a different place. And then you have financial fragmentation for geopolitical issue with creating countries creating different payment system, ring fencing their financial system. What is the future of Basel, FSB? What role can they play in this world?
I don't think it's new, these tensions and conflicts that you're discussing. I mean, in some ways, that's why it was created. I think every countries are trying to find some common ground, maybe improve the overall situation, but always thinking about what their country's interests are. So, as you said, we were both done FSB work in the past, and I chaired the FSB SCAV for the last couple of years, which is an assessment, not writing the rules, but an assessment of the risks. There were always issues, even over the last few years, where, cooperation I thought was quite strong. The U.S. was never as forward-leaning on climate change and risks as most other countries. And that was an issue for the last couple of years. There's always been some issues. And it's really important to be able to have those discussions. And that's why I say ever more important. I do think, it's always been the case that you want to collaborate. Maybe that's shifted down a little bit. But even into those situations, countries are always looking at how does this affect my own country? That's always been there. It's just part of the discussion. So it's incredible. I view it as just really important. It's not totally new. It's just the degree, coming back to our political cycles that we talked about earlier.
I think one of the challenges, like, it was already there even when I was at Treasury, and there was maybe more collaboration posture. Like, I think of an example. You mentioned about transparency and data. A lot of the value added to me was some of those projects were collecting data globally. That's one place where you can bring, like, I don't know, the shadow banking report, right? That's one place where you have those efforts. To me, they will be even more difficult because there will be less willingness to share vulnerabilities, data. That undermines, I think, one of the main big value added that a place like the FSB has.
I think FSB got to a position where it wasn't, I know like BIS and had these large ambitions of total sharing of data. And there's a limited amount of data that can be shared without lots of problems with confidentiality, and that every country's got its own kinds of agreements and that kind of thing. But when I was there, I thought one of the things that we were able to do is to, instead of like create a collective database, many countries could do their own individual analysis and then bring it together. And we could get a lot from that without having to create one common database that you had lots of problems with who had access to it and that kind of thing. So I think there's ways. You have to get creative. There are ways, but it's an important mission. The new leadership in charge, I think, has strong financial stability convictions. And so I'm optimistic that this will just be one more phase and one more part of the changes that come along.
We can't get to the end of this podcast without asking about Treasury market stability. So I'm going to ask both of you, what is the fix? And this is occurring in the context of a declining dollar, which is a little bit, I don't know. I have bad memories of the Treasury market and a declining dollar under James Baker. But so, if we can't get political agreement to limit the growth of our debt, what the heck is going to happen? And maybe I'll just ask as a beginning, since you worked on this, Nellie, is it primary dealer balance sheets? Are they fixed? Do we have enough capital in the system to trade all these treasuries?
So I think there's two questions there, and I'm going to separate them just a little bit. There's fiscal and the amount of treasury debt. And I guess I'll make a statement that I think financial regulations can't fix that problem.
Right.
Okay, so that's why I want to separate them. Financial regulations can try to do a lot on treasury market liquidity, but it can't, one of the major problems is the amount of debt. And I would like push against the premise that with treasury debt having to go up, the primary dealer balance sheets need to be expanded so they can absorb all the treasury debt. I really want to just say, no, you should probably reduce the amount of treasury debt. So that said, I think primary dealers are, I would just go back to April, Tariff Liberation Day. There was a lot of volatility for a week or two, and there were lots of concerns about the dollar, the sustainability of fiscal debt, and treasury dealer balance sheets. There was illiquidity a bit because volatility went up so much, and that's what you would expect. When volatility goes up, everyone pulls back on risk-taking. But in my mind, the market functioned, and it repriced treasuries and repriced the dollar in unexpected ways. I don't want to take away from that, but that's part of what was the issue, but it wasn't a breakdown. Okay. Now, I've had some dealers say I couldn't get a quote for 12 hours or whatever. It wasn't instantaneous. There were problems. But you kind of look at metrics of market depth or bid ask and all that. It was things deteriorated a little bit, but so did volatility. And I would say it wasn't the dealer, the market liquidity metrics that made volatility get bigger. It was the real economic news that caused the problems. So I think they actually came through that fairly well. So there's dealer balance sheets, there's central clearing, which is easing up balance sheet capacity, or can either through sponsored repo already easing up balance sheets, plus more with central clearing to come. And I just wrote something with a former colleague, Hao Xiangju, who had been at the SEC, and he's an MIT professor, a finance professor, and we just wrote something on that. But I would support some relaxation of SLR. I did in 2018 and 2020. I still do. I don't think it should be the binding constraint. But we've also, the Fed's put in a standing repo facility. Treasury has a buyback program. We have a lot more data transparency in this area. So I think the way treasuries are intermediated could change. And we need dealers to do the risk intermediation, the helping investors manage risk and to move and transfer risk. But it's not going to be the same. And given all the debt, I am concerned about it, but I don't think financial regulations can fix the entire problem.
What about you, Fabio?
I completely agree with Nellie. Not just because we work together, I just completely agree entirely. I would add only two things, though. I think one I think there's an aspect, the importance to fixing the fiscal outlook. With the Fed shrinking their balance sheet and eventually reaching whatever that steady state is going to be. And two, with the fact that 1/3 of treasuries are held by foreigners, the marginal buyers at this point is not central banks anymore. The marginal buyers, it's a price-sensitive investor. And if the fiscal outlook is not fixed, eventually that term premium, that additional remuneration has to all that duration risk, will go up. And so that's not something you can fix with financial regulation. That means bringing back trust into the fiscal outlook of the U.S. So I want to reinforce Nellie's point about separating the two. The second point, I think, which is similar to that, is I think ultimately the willingness of financial institutions to be in the treasury market is not just a function of the cost of capital balance sheet. It's also a function of how much yield you make, how steep the yield curve, right? So you can ease all your balance sheets you want. If there's no yield to make on the spread, there's not incentive to go in. It's not just a cost piece in terms of the balance sheet. There's also a remuneration piece of involving the balance sheet in some of this trade. So that, again, that's not something you're going to fix through financial regulation per se. That's a market price.
I did see a Goldman Sachs executive say at the Fed's bank capital meeting that we make money in volatility, so that should be changed in the stress test. It was an interesting point, and the banks did make a lot of money in proprietary trading. So maybe your point is well taken, Nellie, that they did step up. They did seem to make money. But that doesn't solve the overall liquidity problem of having just more and more debt.
That's right. And more and more debt is not just a treasury market liquidity problem. It's a fundamental macroeconomic problem for the country.
Mm-hmm.
And not only because there's going to be illiquidity in the treasury markets, but a rising share of government spending to interest payments, and coming back to the loss of the dollar's status. And the U.S. benefits whenever there's bad shocks in the world goes to the flight to quality to treasuries. The U.S. benefits quite a bit from that, and keeps our recessions a little less deep and a little shorter. And somehow, if we lose that privilege, there are some real macro costs. This is the downside tail risks are getting bigger from this. And it's, again, not just treasury markets, but it's a macro.
You can also argue from the macro side that fixing the fiscal outlook, considering that both firms and households run positive savings in the US, savings balances, that you will actually help fix the current account piece of it as well. Because that is a macro story.
Yeah.
Now, of course, you need other countries to fix the flip side of the US deficit, but with those two in surplus from a savings perspective, the money is being brought in essentially to finance the current net negative savings of the US Treasury. So that would be one way to actually fix some of the fiscal trade issue as well.
So I can't close this without taking up Nellie's story. So Fabio, you're the Federal Reserve, and you go down to the plaza and you say, hey, I want into this party, and I'm here to take away the punch bowl. And the host looks at you and says, you have no jurisdiction in here. I'm not a bank. And my regulator is inside the party. He's that drunk guy over there. So then what do?
I suppose you set up a facility with some alphabet soup name and provide liquidity, like some non-alcoholic liquidity that morning.
Yeah. And then you call all the participants to a meeting the next morning and you say, guess what? You're going to be regulated, and here's some tougher rules.
You provide detox liquidity facility in the morning.
Yeah. Any final questions for Nellie, Fabio? This has been such a great talk.
No, I just want to thank Nellie for participating.
Thanks, Nellie.
And for taking the time. I hope it was fun.
Thanks for inviting me. Always fun to talk about these topics.